you look at the overall setup for the markets, clearly we have seen a slip for the third straight day on the trot, and if anything were to blame, it would be some of those heavyweights that haven't quite performed in yesterday's trading day. In fact, put the spotlight on the likes of a Reliance Industries, an ICICI Bank or an HDFC Bank, and there were your key culprits in trade yesterday. By and large, the global setup, that continues to remain quite steady, but the FII outflow, that continues to go on, and it seems like defensives, IT, FMCG and the like, that has bucked the trend. So Nikunj, if we're just looking at this from a holistic standpoint, the fact that the FII flows continue at a time when the global outlook is steady and the heavyweights have really borne the brunt of the sell-off yesterday.
So Avan, there are two sets of looking at the market. The external setup, which is the global setup, which I think is okay. There's nothing wrong with the global setup, whether it is crude, whether it is a dollar index, whether it is communication from the US Fed or any other narrative. So status quo in terms of the global setup. Local setup is strikingly different, and I think it is more like a technical adjustment in the market which is very sharp. Is FI selling leading, is that leading an uptick to the volatility, or volatility is rising ahead of the important election event? I think it's a combination of both. For me, sell in may and go away, while it is applicable for the global crowd, it is not applicable for the domestic crowd. And a 46% spike in volatility combined with FI selling, that is jamming the market now, because now the chatter in the market is that, okay, why are FI selling? And if they continue to sell in the run up to the election, how much more market can absorb? And technically, when VIX it goes higher, the technical algorithms or the setups in the market, they tend to really turn. So in the near term, there is going to be more numbness in the market. You have to prepare your portfolio for a swing and a sharp spike. So intraday spikes, sharp movement within a band, focus on risk and FI selling. Unfortunately for the local crowd in the near term, which relies on technicals, which relies on flows, which relies on global, global inflows, that's not looking strong. So the market, in a sense, looks like we've hit what could be called as a glass ceiling, and what could turn until and unless something changes on the flow front or on the volatility front in the near term. I guess the market will be trading in a band, and the bias, I think, is not going to be, the direction is not going to be strong.
Yeah, and data seems to be suggesting, though there's not much proof, but it seems that flows are moving to China, and quite a few factors as well. Of course, compelling valuations over there. They've been so cheap, but seems like the consumption trends have still been resilient. There is rising dividend support as well. We've already seen a sharp year-to-date underperformance, and the pickup in tourism as well seems to be sort of indicating data points that China could make a comeback.
See, Aisha, the data seems to be indicating that, look, flows are moving out of emerging markets like India. And if flows are moving out of emerging markets like India, we generally tend to assume it is moving into China. Now, for the longest time, over 2.5 years, we've argued that Indian markets are expensive, Chinese markets is where the valuation is. And there are emerging market funds which would like to take that kind of a view, and there is merit in taking that view, which is that India is trading at premium valuations and China is trading at discount valuations. But just because China is cheap does not make it good. The experience of those who invested in China over the years, I think, has not been very gratifying. So I think from a large exodus that money will move out of India and it will move into China, and that's going to be a multi-year trade and a multi-year trend, I doubted this much. See, in the short term, markets will always chase performance, and Hong Kong has done much better than what India has done. But you have to put things into context and then look at the Chinese stocks and what is happening in that part of the world. Growth coming back, not coming back, that's anyone's guess. Have foreign institutional investors forgotten what kind of hits and what losses they've taken in their portfolio because they've invested in China? I think they need to think again. See, I don't think this is a trend in making. Yes, there is an interplay where money is moving out of India, moving into China, moving into other emerging markets, but I think you will see clarity on that sooner than later. And I've always said that we've argued it for the end of time, that Indian markets are trading above historical valuations, China is trading cheap, but then if you're buying something which is quality, you'll have to pay premium for it. It's like saying that in India, the quality and the pedestal positioning will always command some kind of premium.
Okay, that's the outlook when it comes to the overall FII picture. But if we were to also take into account the other big trigger for the markets, and that is clearly the Lok Sabha elections. We had phase 3, which resumed, and traditionally we saw had more seats of the BJP, and the setup saw 64% voter turnout of the 93 seats that went into polls yesterday. 74 were held by BJP, that's in 2019. So that really is the overall tally, Nikunj, when it comes to the voter turnout.
So yesterday's voter turnout from a market standpoint, like you said, that look, it was the 93 seats were polling held yesterday. That in a sense, out of them 74 are currently held by BJP. High voter turnout means that it is good for the current ruling party. Since in the phase 1 and phase 2 voter turnout was not all that strong, market started assuming that okay, the assumptions in terms of where the final tally would move, could that change? But these are things which will happen in the short term because you are pitted against a very large event, and in the run up to the event, a lot of opinions, a lot of back and forth, a lot of calculations, a lot of assumptions would happen. So these are moving parts right now. If you're a long term investor, please ignore it. I don't think this is something which is going to move your long term portfolio. If you really want to look at the impact in terms of election, a month ago, if you would have asked anybody, they would have said that the outcome of 2024 election, which is that the current government coming back, is something which is priced in. But the numbness in the recent decline and the way market has reacted after phase 1, phase 2 FII selling, you could actually make a case that if markets remain where they are, there is a case for a post-election rally if markets like the verdict. If this market would have gone closer to 25,000, you would have said every kind of good news is priced in. But that is not the case. I mean, it is now really the reverse which is happening, and election outcome is still about 4 weeks away.
June 4th.
June 4th, 3 weeks away actually. In 3 weeks, if the market goes down by another 2-3%, then technically means that markets are light in the run up to the event, and which is what you want to see.
Yeah, absolutely.
But it's a busy week indeed. We've got a whole host of earnings that are slated to come out. Today itself, there's Hero MotoCorp as well as L&T, and then through the week, the likes of Tata Motors, Cipla as well as SBI, BPCL will be coming out with their quarterly performance. So that's something as well that the street will be tracking quite closely, Nikunj. Watching out for big numbers.
Yeah, the two big numbers essentially would be SBI and L&T, and both in a sense are important. They both are proxy on economy. Now, SBI has not really been like a real outperforming stock. They've had a little bit of numbness in the numbers, largely because the credit growth was not that exceptionally strong what we thought. So that number in a sense could be important. Then there is L&T, again the darling of the market. It is again a market moving number, but the most important number from a market standpoint in the near term, I think, would be Tata Motors. It comes out on 10th, and that in a sense is also market moving number. Looking at the run up what the stock has seen right now, expectations from Tata Motors I think are running high. So I would look at the stack by saying that SBI, a beat is going to have an impact in the stock in the short term because last 2 quarters were not extraordinarily strong for them. L&T expectations are decent. So if even numbers are in line with estimates, the market would say, okay, 2, 3, 4, 5 quarters, 6 quarters, 8 quarters does not matter, you are in for the long haul. Tata Motor is where most of the triggers have been played out, whether it is demerger or news on demerger of the passenger car business and other businesses, the entire ADR, operating leverage benefits kicking in, debt coming down. So the challenge now for Tata Motor is that for stock to sustain after this like massive monster outperformance in last 1 year, the numbers really have to be above expectations. So SBI, little bit okay, mild beat, the stock reaction could be positive. L&T, even if numbers are mildly below estimates, in line with estimates, I don't see the stock reacting at all. Tata Motor is where you want to see fireworks for stocks to sustain.
Right, okay, important numbers. But then how can you not talk about the FMCG outperformance, which is currently at play? Of course, very upbeat volume growth as well. The commentary on that coming in from most managements, and positive surprise from rural demand. And the fact that they were so underowned, that's why their entire, the bigger alpha in the entire sector.
See, if anybody is expecting that, oh, this is a new trend in making and these stocks will do what a defense sector has done, what railway sector has done, it's not going to happen like this. I think for me, FMCG is more like a trade, and I think that trade may easily extend itself. Why will the trade extend itself? Because See, markets always react when they are surprised or disappointed. In case of FMCG, the volume growth commentary has surprised everybody. The assumption is that this year we are in for a good monsoon, and good monsoon is great news for FMCG. Third, the impact of inflation when it comes, it impacts your spending. But when inflation is stable for next 2 or 3, for a couple of quarters, that spending cut which happens because of high inflation gets adjusted. And then I think markets are also in this defensive phase of mind, which is that, okay, it may just make perfect sense to sell out of some PSUs and move into FMCG. It made perfect sense to perhaps in the short term, in the run-up to the election, park your money into where you will lose less but you may not gain more. So that interplay is there. PSUs are down, FMCG is up. Commentary is surprisingly positive. But valuations are something which in a sense will restrict the move beyond a point. So 5, 10, 15% depending on the stock you're looking at, I think that's about it. Look at Britannia, 9% up already. Marico, 9% up. Nestle numbers were not great, but markets don't like the whole sugar issue which has come up again. Dabur. So some of these stocks have already seen a run up with the exception of Tata Consumer. I think the deep swell may just continue.
If you like this video, then like, share and subscribe to ET Now.